now joining us. Thanks, Vivek. Always a pleasure chatting with you. You know, if I look at the last 3 months and what's happened in the bond markets, I think 4 months ago, no one thought we would see bond yields at the levels that we're seeing at the moment. You've seen the rupee also perform quite well. But the big trigger, would you say that's being overdone, would be what the FOMC decides later today. Incidentally, that decision only expected around 1 a.m. But could that be the next big trigger for Mint Street? And how crucial is it, or has it all been factored in?
Right. So I think in case of India, big factor is always oil prices. And as far as bond markets are concerned, along with oil prices, OMO buybacks has been a story which has been driving markets. FOMC is clearly most important event in the near-term horizon. And it will matter a lot whether after FOMC we get a softer dollar tone or not. From a broad top-down perspective. So yes, FOMC is important. Having said that, I think as far as Indian fixed income markets are concerned, we are broadly constructive, and though we have seen decent moves, especially in bond yields, we may consolidate here at current levels, but I think the path of least resistance, given the current supply-demand dynamics, is still towards the lower yields.
You know, Vivek, what we are seeing also is, I'm talking about the FOMC, since that's what the market's also talking so much about, and you're seeing a reaction even in the equity markets. You know, you're seeing Donald Trump make it quite clear what it is that the US president would want from the FOMC. The 74% of the economists that have been polled by various global media houses do see a rate hike. Where do you stand? What is Nomura's stance?
So, we stand with the consensus. We believe a rate hike in today's meeting is highly likely, very likely. But I think more important than today's rate hike is what we get in the guidance. So, for example, what FOMC indicates for 2019 and 2020. And from that perspective, I believe we can get a dovish hike. And if we get a dovish hike, despite the hike, EM rates, for example, or EM markets may still do okay. And when I'm talking about EM, I'm talking about EM Asia, such as India and Indonesia. So a hike hike is something which is a high probability event today, and we believe that. But again, I think what matters the most is what is communicated, what gets communicated to us for 2019 and 2020.
Right. Vivek, what is the sense that you get? What do you think are global, equity and bond markets adjusting to when you talk about such rate hikes in the US markets, liquidity drying up, going ahead? In 10 years, markets are used to liquidity, and now that it's going, it's that adjustment phase which is creating, some random moves across asset classes?
Absolutely. I mean, 2018 has been a very tough year for a lot of markets because, this is the first year, if we get the hike today, this is the first year in a while when Fed actually hiked 4 times. Liquidity policy normalization is happening across big central banks. So, indeed, it was a tough year. And that's where probably today's decision becomes even more important, because I think we may be moving into a stage, we may be moving into a environment where, we are moving into a phase where Fed tightening cycle is looking very matured. So that's one. That will be a big change from 2018. Oil prices, which were rising all across 2018 until like October or so, September, October, they seems to be stabilizing at lower levels. So yes, I mean, I absolutely see the point that you are trying to make here, that it has been a tough environment and Fed hike has been one of the big reasons. But I also want to point out that going ahead, it may not be too bearish, because some of the big factors, especially for EM markets, because some of the big factors like Fed tightening cycle reaching in a mature phase, oil prices are hovering at lower levels. So those are the things which are changing, and we have to be a little bit careful in extending things into the next year.
Right, point taken, Vivek. Just also about the OMO that came in, you gave your view, of course, on that and what essentially is expected. But what is the signal that one is getting from the new governor? You think markets were expecting, that policy stance may be accommodative going ahead? This is the signal which is coming in, or do you think that markets will still wait for this first speech? Once any of the meetings happen?
So one thing is very clear. I think on liquidity front, RBI is taking a very proactive approach. I mean, to be frank with you, even in the last policy meeting, monetary policy meeting, Dr. Viral Acharya made a comment that they will be proactive in terms of infusing liquidity, and there may be aggressive OMO buybacks. So what we saw today, in terms of those words getting converted into actions. So now we are getting a OMO purchases of 500 billion per month. I think one thing is very clear to me, that RBI now very well understands that keeping liquidity in a neutral or probably even surplus mode is important, especially in a current environment where inflation is not a problem, and because India has been operating in a liquidity deficit mode for far too long. And I think the power of liquidity is very strong. We will see positive impact coming on to the economy as well as we go ahead, and this will be very much visible in 3 to 5 months' time. Now, I think as far as dovish signal, etc. is concerned, after last inflation print, after last RBI policy meeting, expectation is that RBI will be dovish. And I think, I generally believe, whether it's a function of being proactive on liquidity or not, I generally believe that RBI will turn more dovish over time. We will definitely see a change in stance from calibrated tightening to probably neutral going ahead, given the way growth and inflation is panning out.
Sure.
Okay, we're going to leave it at that. Thanks, Vivek, for joining us here to talk about the bond yields, Mint Street at large, and what it is that we all need to keep a watch on. And Vivek was quite categorical and emphatic about this. Besides the FOMC, crude price is the biggest determinant. So let's talk.